Good morning and welcome to IQIX Insights. Today is Friday, July 10th for pre-market. As you can see, I'm at the World Cup game for England and so reporting from the front line, but obviously the stock market is more important, so let's get on with it. Looking at July, we are in a seasonally very bullish month. So going back to 2015, we haven't had a down month for July. So you can see the last time we had a negative July was 2014, and time before that was 2011. So it's quite a rare occurrence. The only caveat I would say is that in 2007, obviously leading up to the financial crisis, we had a negative 1.5% return in June and then 3% in July. So if you are thinking that we are at the peak of a bubble, etc., maybe there is some caution there, but otherwise, statistically speaking, it is a seasonally very bullish time. Now, looking at just the mid-year terms, so every 4 years, July is slightly more mixed if you go further back, so 1998, 2002, but still only one out of the past 6 midterm years going back to 2006 was negative. And also a weak June doesn't necessarily translate to a weak July. If anything, it looks like mean reversion, so down 5%, up 6.8% in 2010, and then down 8% in 2022 in June, and up 9% in July in 2022. And then this is the midterm years going back to 1998 and how year-to-date we're performing versus the historical terms. As you can see that we actually probably the second best midterm year going back to the past 8 occasions. So the best year we saw a 20% year-to-date return already at this time, but 10% is already very good because if you look at the history of S&P, usually it averages 10% a year. So we're already getting there by just half the time. So looking more in detail, so in the past 20 years, July has been bullish, but also in terms of the individual days is unusually green almost every single day until probably the last 5 days of the month or last 1.5 weeks of the month, especially in mid-July. So going anywhere between the 8th to the 23rd, we're basically seeing a very green streak. So I would say that seasonality is like a tailwind, all else equal. If we don't have massive external shocks, etc., then this is how investors tend to position at this time of the year. But it doesn't mean you should throw caution away. Now, looking at my latest update in my service, so I'm dedicating a bit more time on expanding our universe to match what we already offer in the machine learning signals. So I'm also doing a human judgment version of tracking different tickers using technical analysis. And my method of technical analysis is really just the core efficient version of classical tools as well as Elliott waves. So you won't see the previous types of waves 1 to 5, ABC type of stuff, but we actually just look at the core structural market developments, comparing one rally versus another and one seller versus another, and looking at the ranges, the drawdowns, and the key a key element of what I do is I'm now tracking them as if we do for our machine learning signals for each ticker. So I cover each ticker once a week on the technical analysis side. That is about the right frequency. So any more frequent than that, we are looking a lot at noise over the daily movements. Over here, this card will show you what I see as the price structure. So whether we're in an uptrend or a pullback or in a sharp rebound, the rebound is a sharp move upwards within a downtrend, and my tactical positioning according to technical analysis. So this is uncorrelated with the machine learning signals in the sense that this is completely independent. And this is my TA opinion, and that sometimes I could be turning overweight before the machine learning signal does, or underweight before the my signal service. So this just gives you another lens. So I would see this almost like as a separate model to what we already offer, and it should help you understand the market structure and the market movement in a more holistic way. And an example is that internally I'm building a tracker where I'm tracking the charts I've shared with and my rating at a particular point in time. And over time, we can track, okay, if I'm overweight something, how well have those tickets performed? If I'm underweight something, how well have those tickets performed? Is to hold myself accountable, but also if I'm going off the wrong track, so if I'm consistently underweight, but the market is telling me no, there is a way for me to quantify how big that mistake is and rectify it early if I need to. Something else I would like to bring back, so the cycles scanner. So we have previously looked at cycles. So cycles is actually a mathematical tool using different formulas to detect repeatable trends and patterns in the past few years for a particular asset. So we all know things move in cycles. There's ups and downs even if in a really bullish asset, there are always going to be ups and downs, whether it's individual to the ticker or with the macro environment and the business cycles. And basically, we're examining the past 5-year data in this scanner to see, okay, for example, Bitcoin, are there any dominant cyclical patterns? And we are synthesizing the top 3 cycle detected cycles together to form this chart. So this shape, as you can see, is not as smooth as this one below for Reddit, because the top 3 cycles synthesize into a slightly wonkier shape, but that is the kind of the net results of those 3 cycles moving together. Some are short term, some are long term. And this scanner here, this page here, shows all the tickets that are in the current uptrend that I'm sharing. So it looks like Bitcoin is about to enter a uptrend within the 5-year look back, same as Robinhood and Oracle, as well as some other popular tickers like IREN, ETH, and even CoreWeave. But I would be a little bit cautious on the names with shorter history. So for CoreWeave, Reddit, these are newly IPO'd stocks. So our 5-year history doesn't capture, is not being filled in full, which means we are only really looking at fairly short-term cycles that's been spotted in the past couple of years or even 1.5 were available. And they're probably a bit less reliable than something that has stood the test of time. We're looking at Rocket Lab, Vistra, and even Coinbase, and even gold potentially could be seeing some rebound next, according to the cycles analysis. But on the downside, it looks like Micron could be peaking according to this chart. Duolingo has recently had a rebound, and it could see a pullback. ASML as well. Tesla has been following this 171-day cycle within the 5-year look back, and we could see potential weakness going into end of Q3. So here is just a reference point of how tickers behaved. It's not necessarily a prediction, it's more prescriptive of, okay, these are the cyclical patterns we've seen, and this is where the ticker is at. But with more data over time, those cycles also move because we're detecting maybe more trends and cycles with more data, and some cycles could show weaker signals going forward and therefore drop out from the top 3. So I think that's just to for you to also bear in mind that these cycles are not necessarily static. Moving on to the macro, so looking at the Fed, yields have come up a lot in the short end in the past 3 months. Even though we had a slightly weaker than expected labor market, what's clear is that until we see a fresh set of new prints, inflation has been heading the wrong way. And I know people are now expecting oil prices to come down. They have come down a lot, which could cool the inflation pressure or even bring in deflation because of the drop in demand versus the previous year for oil globally. I think the Fed is clearly not trying to show its hand too firmly and has been focusing on the inflation piece and delivering price stability. So in light of Walsh's new Fed and how unanimous the Fed voters were in leaning towards keeping rates and not cutting rates or hiking rates this year, the market is unwilling to price away the implied rate hike for 2026 at least. So still we're seeing the market pricing in a 40 basis point hike by May 2027 and at least a full hike before the year end. And now looking at the past 3 months, we're seeing the front end rising the most, up 37 basis point, as I said about the rate hikes being priced in, whereas the long end has risen about 15% in the 15 basis points in the 30-year yield. And it's a lot of it is thanks to term premium coming down from the highs, which has basically held back the yield rise in the long end, which made the yield curve a bit flatter than before. And finally, before we do our chart analysis, we just quickly go through our multimodal signals for where we are today. So this is across all of my signal asset classes. We have the macro at the top, Max 7s, mega cap equities, commodities, commodity ETFs, and equities. So I've built in some equity names for commodity section, and then crypto. So there will be more names coming, especially in the crypto side. And for the crypto service, I'm going to expand it into more like financial infrastructure and digital assets to include some TradFi name as well. And there will be more names coming in across the board anyway. And the long-term aim is to be able to create a automated portfolio given our signals, but much better risk managed than just equal weighting allocation, for example. And we can see that equities on the index level and even on the sector level for semis and software, they're still very bid. Credit is still pretty bid. The dark blue signal that the majority of signal engines across machine learning, neural nets, and trend model and market regimes, they are in a broad consensus for the direction, for the bullish direction. And the dark orange means they are in broad consensus for staying out of the trade, staying on the sidelines and not buying the asset. So it is much more mixed for the Max 7s, as you could have told from looking at the charts as well. Only Apple and NVIDIA are long by the multimodal signal. For the mega caps, most of the semiconductor names are still very bullish according to the signal. And we only have Palantir and Qualcomm that the machine strongly suggests we should stay on the side. For commodities, gold and silver are on the sidelines in broad agreement by the engines. We do still have some long signals here for example, copper, but overall, this area is more mixed section. Now, crypto still broadly suggesting we should be on the sideline, although I think the recent price action that have favored a bit more bullishly for Bitcoin ETH, the models are in a bit of a mixed agreement. So our model is saying we stay flat, but only 2 out of 4 models really back that decision, although that combination of the models who back it have proven to work better for this ticker. So what I would say is that higher consensus, because each engine looks at the market through a different lens, higher consensus doesn't necessarily mean there's higher conviction. What it means is that different styles are in agreement in this particular market regime. The way I have built our service is that for every ticker I've tested either whether a single model would work best or a combination of models would work best for that ticker. It doesn't necessarily require all 4 models to agree for us to take a position, because by the time that happens, the rally or the sell-off would have matured. So it could be too late to take position in that. Your risk reward is lessened. But it just gives us a great way of judging how many styles are working for that ticker in this environment. So I would like to start with TLT first today. So the Treasury bonds, we sometimes overlook this because we already talked about the yields. What I would say is that there is a clear stalemate between those who are buying and selling bonds over here. And the range of the price action has been narrowing since early 2025. TLT has found it really difficult to break above 89, basically. It tested this 3-4 times and it couldn't get over it. So until we see a breakout or breakdown, really we should be neutral here. There isn't really much of a direction that we could lean on with conviction. And we can see that most of the volume is building around this neutral point at around 84, 85, and that's where the moving averages are as well. Oil, so oil is interesting because we sold off pretty aggressively after the peace deal, so in June. And this second sell-off has basically reached the 150% of this initial sell-off. So that looks a little bit extended already. The market has picked a rebound after renewed airstrike between US and Iran, but it's not moved up extremely aggressively. So I think if you look at the volume profile here, there are probably a lot of people who are dumping oil when we are reaching this 100-day moving average region. So overall, this is still a clear downtrend. I would say sell into strength in the next rebound, and I would expect one more sell-off to at least test 200-day moving average. So SPY, obviously, we had a very strong uptrend after the initial ceasefire between April and May, and we entered a consolidation period for June. So I would call this more like a range bound structure. So in an uptrend, when you have a range bound structure, that looks like a bull flag. So once we resolve, it's likely we resolve for higher. But in meanwhile, it is not clear that we are immediately breaking out. So if we do break out, July is the month to do so. But we can't confirm that the breakout until at least we establish a new high. So over here, if we see weakness, and that means we have one more sell-off in this as entire range, then we could test 710. But I think the risk is fairly balanced here. So we just, again, need to see a breakout first. QQQ has been a little bit more bearish than SPY, is further away from its all-time high, because semis has been very volatile. So again, this is clear a range. You can call this a bull flag after a sharp rally. And this second sell-off versus the first one, this didn't really touch the 100%. It's only touched about 2/3 of this initial sell-off. So I think there's a chance we can retest the bottom of the range before moving higher. But over here, I'm just neutral. I don't really have a strong bias either way. It could break out next week, but we need to basically see it before leaning more bullish first. IWM. So IWM is in a more clear uptrend, so I wouldn't even call this a bull flag. This is just a uptrend that is slightly less angular than the initial April rally. And we're seeing a little pullback here. If this pullback repeats what we did in the first set of S1 and S2, which were equal size to each other almost, then we can again test the bottom of this channel, or at least the 50-day moving average. So over here, I would say I would stay neutral. If I have a position, I would hold on to it. No strong bias really for a fresh position or being bearish here. For semis, I just want to show that we had a strong rally last year, so between May and December. That was correlated with the rest of the equities market. We had a very strong year after the Liberation Day bottom. But the real parabolic run happened after the ceasefire this year in April to May. And if we look at where we are today, today's price for SOXX around 580 was basically where we were at the end of May. So we spent the past month or so basically consolidating in a range here. Could this be the topping sign? So if you measure the 2025 May-December rally, and we are comparing the latest rally against that, we are looking at this rally reaching past the 75% of this rally, so more than 3/4, but not quite 100%. So theoretically, it could still grind higher over here, but what I would be cautious about is the shape of this consolidation. So if you zoom in, it's feasibly that could be a head and shoulders pattern. So left shoulder, head, and potentially forming a right shoulder here with a neckline over here as support. And if we couldn't find one more high and it falls straight below this neckline, then we could potentially have topped, because that's the classic head and shoulders pattern breakdown. So really, the trick is whether we can have a rally that surpasses this high here. If we can, then it's continuation upwards towards this 100% mark, pointing towards 100, which sounds ridiculous, but the stock has, the ETF has already doubled in the past 3 months, so you can't really rule anything out in the final phase of a blow-off. Looking at IGV, so if we repeat this rally here from now, then that points towards basically a new autumn high, getting past the October high, which started the software sell-off, and points towards 120 region. And this sell-off here reached only about 62% of this rally. So this does look like a larger degree pullback in the uptrend, even though it's a little bit steep, but it's very feasible. So in any wave terms, you would see this as wave 1, wave 2, and wave 2 can reach 60 to even like 78% of this rally 1. So if we're looking at a potential second rally, and in any wave terms, wave 3, we're looking at an initial target of 120 here, if not higher. What I'm less sure is that we have some strong updates and then momentum has faded a little bit. We're basically trading in a quite neutral area between the 100-day, 50-day, and 200-day moving average. So we're not really seeing a strong breakout to really confirm that this is a rally too. So I just want to see this breakout, get above the 200-day moving average and confirm that we're on the way and we're looking at a more overweight positioning for IGV in terms of technical analysis. So our machine learning signals already risk on, but from a technical point of view, this move is still quite early days for me. Looking at Bitcoin, so we have seen 3 big sell-offs since the 10/10 liquidation event last year. So the first sell-off and the second sell-off were almost identical in size, so in terms of percentage. So we're now in sell-off 3, and if you look at this consolidation pattern versus that one, they look pretty similar. So the question is, have we finished sell-off 3 after moving past June, or is there more to come? So this is still a quite firm downtrend, I would say, and we're still below the 50-day moving average. So even though back here we moved past the 50-day moving average, we still saw another leg lower. So right now, I am still quite suspicious of this rebound, and I think S3 has reached about 3/4 of S2. It hasn't fully capitulated yet in terms of size, and we could have one more leg lower towards that 50K mark, which could mark the bottom of this cycle. And really, the real test is whether Bitcoin can get past the 200-day moving average, which it has failed to do so since the end of October. So that, I think, is real test. The 50-day moving average is almost irrelevant in this downtrend because it's been repeatedly moved past and then dipped again. So it's not a reliable signal. For ETH, again, for ETH, we're seeing 3 sell-offs here. So S1, S2, and S3. S2 was almost identical to S1 in terms of the size. S3 reached 3/4, 2/3 to 3/4 of this S2. So it looks a bit incomplete. I think I'm happy to wait. So even if it clears the 200-day moving average, which currently is at 2,200, but it will drift lower by the time it meets. And even if I buy when it crosses over the 200-day moving average, that's not that much higher than where we're now. I'm not missing out a lot. And if you really believe in the ETH story that it's going to move to 10K because of the financial infrastructure play for agentic payments, then the risk reward is still pretty good. And arguably, you're capping the downside and managing the risk better by buying after the reversal than during the downturn. Robinhood. So Robinhood is a strange one here in the sense that I think it no longer is that coupled with crypto. The crypto revenues used to be number 1 revenue stream for Robinhood. Now it's like number 3 after equities. And I think options market, and I think prediction market is probably going to overtake as well. So now it's in this fresh momentum for another rally. And if you look at the previous rallies, so rally 2 was 130% of rally 1, and then R3 was similar in sizing as R2. It's not exactly 100%, but very close. So if we take this repetitive rally pattern, and let's say we bottomed here, then R4 can point to a target of $300, which basically replicates the move in R2 and R3. It sounds like a lot because we're only trading at 115, but if you just look at where R3 started at $30 and it finished at $150, that's a 5-fold increase. So it's, Robinhood is no stranger to big rallies and equally large sell-offs. And the positive signal I'm seeing is that we are seeing the 50-day moving average crossing above the 100-day, which historically confirmed the uptrend. So it did it here in R1, also here about 1/3 way through R2, and here quite early in R3. So you're never going to catch the absolute bottom, but this confirms the uptrend. So we've just had that recently. Realistically speaking, can we get past the resistance in one go, in one clear motion? I'm not sure. And also, this is pushing this upper side of this price channel since the bottom, since the March bottom. So again, we could see a pullback, in which case, if we see a pullback, I think is an opportunity for upgrading my rating from neutral to overweight and try to capture this massive rally. Or alternatively, you could just wait for the decisive breakout first. If it breaks out, which would confirm that actually we're probably in an uptrend, we're going to head towards the all-time high. And even though, you know, let's say you bought, let's say I bought at 140, that's still a decent doubling from where we are, and that's almost capping the downside, because now I have a very visible support, resistant turn support region that I can use as a stop loss, or even the 200-day moving average. So there's a lot of ways to play this, and so I'm more keen to see how it moves next. Coinbase. So Coinbase has formed a massive head and shoulders pattern from 2024. Unfortunately, this sell-off was almost 60% from the highs, but it has held above the support. So if we fall below the support, then I think we're looking at massive sell-off again, pointing towards sub 100. But if it holds, and we have seen this pattern hold to a more bullish outcome in other tickers, I will go on to show you, for example, in Netflix, then if it holds and we can start moving high from here, we can invalidate this head and shoulders pattern still. MicroStrategy, unfortunately, MicroStrategy looks much more bearish in this case, because it failed to hold this head and shoulders neckline. And not only has it failed, this support has now become a resistance that strategy has to clear. I think there is a lot of doubt about the funding and liquidity issue of MicroStrategy's preferred shares, which promises anywhere between 11 and 13% annual yields. So Saylor had to sell Bitcoin to fund that, and he has done so. So there is a lot of lack of confidence right now. And as you can see, that MNAV used to trade at 200%. So the shares traded 200% above the net asset value, now to basically par, and it could trade at a significant discount as well because of the tail risk. Looking at gold, so we had a three-phase sell-off, each one longer than the others, but similar in the actual size of the move. We had an initial deleveraging event at the beginning of February, and then we had a sell-off in March, which is 100% of S1, but it took a bit longer. And then we had another sell-off in Q2. Again, that's 100% of S2, which was 100% of S1. So S1, 2, 3 were equal length. And I am expecting a relief rally to sort of test the 200-day moving average and the top of this channel here. It doesn't mean that I think we can break through it, because there's a lot of volume here with investors who might want to offload when it gets to break even. But in the near term, I think we can see potential rebound. Machine learning signals are not too confident yet, because rightly so, we're in a downtrend. But technically, I think there's a chance. Similarly, in silver, we're seeing sell-off in S2 actually only 2/3 of S1, which was interesting. It didn't reach the full extent. And the S3 was 100% of S1. But if you think this is just one sell-off, then S3 only reached about 70%, 75% of this move from the January high to March low. I do think we potentially have hit a support level, which was the high in October, and we could see this potentially bounce like we see in gold together in the near term. Is this the firm trend reversal? I'm not so sure just yet. I think we need a lot of confirmation by silver at least climbing above the key moving averages. Also looking at the volume, where the 100-day moving average here, that's the highest volume profile, which could represent a key resistance once it rebounds. Copper here, so copper is pretty volatile, and it is still holding a quite firm but volatile uptrend here. So around here, in the near term, it could really just drift within this range. So what I'm a little bit cautious about is whether this is a head and shoulders pattern that's playing out. So I do think we should want to see the 100-day moving average hold. Otherwise, it could fall through and test below the 200-day. Moving on to Apple. So what I'm seeing here is we're in a broadly uptrending channel. And we had two mini sell-offs that were equal weight to each other. What I'm not entirely sure is whether this is a new rally. It hasn't broken above the high, or this is just more of like a corrective rebound, and we can see one more sell-off that matched the length of those two or even higher. The reason I'm not so sure is I'm just looking at what happened previously when we reached the top of this channel here, and we had a sell-off, a rebound that was close to the highs, and then a subsequent sell-off that tested 200-day moving average. And I can see that happening going into the September announcements for the new products and the holiday season. Typically, end of Q3 and beginning of Q4 is a very hot season for Apple. So I just wonder if investors may back off and wait until that product announcement in September 1st before diving in. Amazon is a quite slow stock, so it's not for the overnight riches. Those days were probably 10, 20 years ago. But if we're looking at the broad trend channel, it's been building since 2024. So this is almost like halfway between a range and uptrend. We're seeing that there is a rhythmical rally happening. We see that R2 was about 100% of R1, which took Amazon from the bottom of the channel to the upper bound of the channel. We also see that in the lower half of the channel, Amazon doesn't actually stay down there very much. So he spent 40 bars, which is about 2 months, in this region briefly, and then went back above after. And again, in March 2026 is this year. So it spent another 2 months in this kind of second half, lower half of the channel, and it moved back off again. So it's actually quite a rare event for Amazon to spend time in the second half of channels, which means this mid channel point is a natural support. But at the same time, it could grind sideways for a while, which we saw in June. Because we already had a little sell-off here, retrace here, I'm happy to lean overweight first to complete R3 at 100% extension of R2, which was 100% of R1. So repeating the pattern here, I think the risk reward does look quite good. And if I had a stop at this low, it still justifies the rating. If a breaches below this low, I would have to move back to neutral. But I think tactically, we could see a rebound towards this high again. So for Google, it has also been in a broad uptrend in late 2025. It's done very well, but its valuation is now about on par with the other Max 7s. Previously, it was very cheap. We're looking at structurally this first sell-off versus the second sell-off here. So the second sell-off reached almost the 100% of this first sell-off, but not quite. So I suspect there's room to test the 200-day moving average before this sell-off completes. And also in this rally here, we moved briefly above this upper trend, but it was failed breakout. So I'm not surprised if we get a retrace like the sell-off one to test 200-day moving average and reattempt to break the trend and move upwards after that. Meta, so Meta is a bit in no man's land at the moment. We are looking at S2 versus S1 that was almost, again, 100%. So what you often see is that the size of the rallies versus the previous rally and the sizes of the sell-offs versus the previous sell-off are almost identical. And sometimes in one, or let's say we have 3 rallies or 3 sell-offs, the third one can get quite aggressive. It almost marks the top or the bottom. It can get to 125% or 150% of the previous rally. So in that case, I'm a bit more cautious. So looking here, if this was a sell-off 3 rather than just a pullback in the uptrend, of course, this hasn't reached the 100% of this S2 because this end was shorter. But if you look at this pullback here and subdivide it into 2 parts, part B was equal weight to part A, and it found support at the bottom of this price channel that was established from 2024. So I'm labeling this as an S3, but really this could just be a pullback in a new uptrend. Right now, it's stuck below the 200-day moving average again with loads of volume profile around here. So I'm still quite neutral. I really want to see a breakout above the 200-day moving average, ideally above here. And in that case, we could be establishing a new uptrend, and we can go from there. Microsoft. So I'm a little bit torn about Microsoft because it's forming a massive head and shoulders. It hasn't fully broken down. So the neckline is arguably a little bit of a range over here around 350 region. So it hasn't fallen below this low here to say, okay, we are going to see a deeper sell-off. But we recently had a lower low in June versus the March low. So whenever we have a lower low, I'm always a bit more cautious that it opens the door to a bigger downward move. So really, we want to see, for the bulls, we want to see Microsoft turn up straight away, getting back past this area and get past the 200-day moving average. Otherwise, I would say the path of least resistance is probably pointing downward. And here's a point about head and shoulders as well. So I think in classical analysis, what you would have is the head to the neckline. And what people usually do is they point towards the bottom of the neckline and then replicate this sell-off further down, which would point to 230 region for Microsoft. I personally would rather be a bit conservative with the downside target and measure from the top of the right shoulder, because then that is a complete sell-off. So we're measuring sell-off 2 versus sell-off 1. And of course, you could extend, but I'm being a bit more conservative on that downside target of 100%, which is $300. So NVIDIA in the near term, it had a head and shoulders pattern. We broke below the neckline, found the rebound at the 200-day moving average, trying to retest the neckline, which has now turned into a resistance. So actually, it's not really clear how this will resolve. Our signals are bullish on NVIDIA, as is with the broader semiconductor industry. But over here, I'm tactically a little bit more underweight in the sense that I think there could be a sell-off from this trend line resistance as well, both from the channel and this neckline, in which case we could see a downside pointing towards 180, so the bottom of this channel here. But I could be invalidated, in which case we see a breakout from this neckline resistance and channel resistance, and above the 50-day moving average, and then we can conclude this whole episode and point more bullishly. So, so neutral to underweight here for NVIDIA TA perspective. and I want to see how it resolves going forward. So Tesla, I think long term, undoubtedly we are in the upward pointing range that is extremely broad, but Tesla, since IPO, has gone up almost exponentially, just in very large rallies and sell-offs. I'm just dissecting this near-term chart here. We had initial sell-off from this local top in December. That's S1. Then we had a rally. So the sub-rallies look identical to each other, so 100% of each other, which are marked as R1. This looks a bit unconvincing because those two sub-rallies basically stopped at 100% each other, and we didn't have any follow-through and coming back down again. So potentially we could be replicating another sell-off of this S1 that could point to 300. The bullish alternative is that this doesn't happen, so we hold already, and we go directly above this high here, which would invalidate this whole consolidation pattern and point to much more bullishly towards the top of the channel, towards 600 plus. So primarily, I'm underweight. I'm happy to go to neutral if we see a breakout, and then more bullishly if it follows through. AMD. So for AMD, we had two rallies since 2022. So the first one had two sub rallies, 100% of each other, and now we're in a rally two that is longer than this rally one. So I think is approaching the 150%. And if you subdivide this rally two into two rallies, then rally 2.B here is approaching the 100% at about 650. So I think that could happen just based on momentum. We haven't even touched the 50-day moving average yet, but I think it's probably not worth chasing here. But I've said that for a while, so take it with a grain of salt. Broadcom, our signals have turned bullish for Broadcom today, and I think from a tactical point of view, I'm slightly leaning neutral only because we had a sell-off here, S1, and S2 all but reached the 100% extension and held at the 200-day moving average. Right now, the price stuck below the 50-day moving average. So I think for me personally, I would actually wait for one more day. If it follows through on the upside, I think that is a fresh rally, and we can start thinking about a much higher target from here, pointing towards potentially 600s. Marvel. So Marvel, I do lean a little bit more neutral or even underweight here. We had channel that it broke out. If we measure this R1 versus R2 reached almost 150% of R1 half after going almost parabolic. And if you look at the near-term price action, we're seeing a mini head and shoulders pattern that basically had a breakdown. ARM is interesting. We had a post-IPO rally over here, and the current rally reached about 100% of this post-IPO rally. We had a 2-year consolidation. So even though this does look pretty aggressive, almost a tripling from this January low, it was after a big basing event. So I think that's understandable. But now reaching 100% of this rally one, are really more neutral. Taiwan Semiconductors, very smooth uptrend. We have had 3 rallies. I've marked this RO because this was before COVID. So R1 was 100% of RO, and R2 is now reaching 100% of R1. So if the pattern repeats, we're closing in the top, which could point towards 520 region. So there's probably another 15-20% to go. But the risk reward for chasing here is probably not that great. ASML, again, we're looking at rally 1 post-COVID, post the bear market of 2022, and then R2. So we're now we've exceeded 100% of R1. So naturally, here's a point to store and pause and assess. Micron. So again, we're looking at the shapes of the previous rallies. We had a post-COVID rally here. And then 2023, 2024 rally, so this would be R2 on our chart, reached 100% of this rally. So again, equal length, a pattern we see almost everywhere. But this third rally here, the super cycle rally, because of the AI bottlenecks, in terms of demand, it's reached 200%. So this is pretty parabolic. We only touched the 50-day moving average recently. What worries me is that the distance away from the 200-day moving average reached the 200% mark. It's still at 115% today. And if you just look back to historical levels, previous peaks, we're looking at 66% distance from the 200-day moving average, 58%, 73% in 2013. Just going further back, 2010, 84%, and then further back to dot-com level, 98% just before the dot-com bust, and 114% before 1999. So you could argue that this 1999 we could be in 1999 and we still have a massive rally to go. But still, if you look at this drawdown here, going from 36 to 17, which was basically half, still pretty unpleasant ride through, and going from 2037 to 88, that looks good if you held on to it. But the caveat is that you would have to hold on to this 50% decline before you find that tripling from the top. QCOM, I think I'm leaning a bit underweight here. We've had a broad range here, and R1 going from the bottom of the channel to this upside channel. And we repeated that, which was 100% extension of this R1. Nearly perfectly, but I would say probably like around 90% mark. And we've, in the near term, had a head and shoulders pattern that broke down. So again, this makes me a little bit cautious. If, of course, if we reclaim this, we could invalidate this pattern. But for now, it doesn't look like it could mean continuous kind of decline towards the bottom of the channel. Intel, we had a long consolidation in 2024 and 2025. You can see the gap down to establish this bottom, and then gap up to escape this bottom. So this is known as the Long Island pattern. And what we're seeing here from this bottom here is R1, because this whole thing is a fairly kind of like the rallies have occurred together. So I actually would want to call this R1. They're quite consecutive, but split into R1A and R1B. So R1B has reached 100% of R1A. Of course, it can extend to 125%, but in the near term, we're seeing a lot of consolidation here. And my concern is that we are seeing like a left shoulder, head, and right shoulder pattern next. So, of course, if it moves new high, it would invalidate that concern a bit. But looking at other charts as well, we're seeing a very similar pattern across the semiconductor names. And in terms of consolidation, I will just get a bit more cautious. Applied materials. Well, R1 here, post-COVID, R2 here, post-COVID bull market, and R2 was slightly shorter than R1, and we have an R3 here that has exceeded both. So it's reached 140% of R2 and 110% of R1 here. So it does look a bit extended. As we can see, we have seen Micron, the final rally does get a bit more parabolic, so you can't rule out that it goes higher. But for me, chasing here is not that attractive. Same pattern here for Lam Research. So the rally 2 here was actually basically identical to rally 1, and so far rally 3 has lasted rally 1 and 2, so 150% of rally 2, very similar to Applied Materials. It's getting into an extended zone, but we haven't really seen the consolidation and breakdown yet, so I wouldn't fade the top just yet. Again, similar pattern for KLA. R2 was 90% of R1 within this range, and then now R3 has exceeded 100% of R2, now at 125%. So again, it's a mature move already. Arista Networks, again, similar pattern. Post-COVID rally R1, R2 was 125% of R1, so a bit longer. And R3 is still ongoing. So if R3 repeats R1, so 100% of R1, we are looking at a target of 216. And if it repeats this R2, so another 25% higher, then we're looking at a target of 300. DELL, so R2 was 100%, 10% of R1, and R3 has now reached 110% of R2. It could extend to 125% we've seen in other tickers, but this move is mature. We've seen even a gap up here that could mark exhaustion in the near term. CSCO, so I think there wasn't a clear R2 and R3 split for CSCO. So we've had a post-COVID R1 in a very broad uptrend channel, and R2 has broken above that channel. It's 170%, 5% of R1. So in truth, this is almost like two rallies chained together, but I've put them together. Again, this looks mature here. This is not really a breakaway gap, and this could be a island top gap. So you have a gap up, and then potentially you have a gap down to finish this as an isolated island of candles, and that could mark the top. But we haven't got there yet, so we just have to monitor. I would be neutral. We haven't seen the breakdown, so I'm not underweight. Western Digital is in a quite smooth channel. R2 was identical to R1, and R3 has reached 125% of R2. I do think the R3 is probably complete now, so we're looking for another consolidation phase that could test the bottom of this trend line like we did here. SanDisk, R2 was a bit shorter, so I'll say R2 is only 75% of this R1. So R3 here reached the 100% of R2, so it was replication, but again, it's only 75% of this R1. I do think the risk of R3 having topped is pretty high now. The question is, how would it consolidate? Could it just move sideways and we see another move higher, or could we break down? So I'll get very cautious if we break below here, and especially the 100-day moving average. CRWV, so this was a sell-off one, and my concern is that we're potentially in a sell-off two. That could point towards 45 as the downside target. This rally here was not very impulsive. It was not bullish. It didn't take out the October high, and it stopped. So this second rally stopped at about 100% of this rally here. So that looks corrective in nature, and I'm just concerned that we can replicate S1 from here. NBIS, so R2 has reached about 75% of R1, which means there theoretically is room on the upside around 500 to complete 100%. But there's a warning sign here because the price has just crossed below the 50-day moving average, which was the topping signal for R1 here, which then led to a 1-year long consolidation sideways. So here I'm much more neutral because of this signal, even after it reclaimed a basic consolidated for a while before we saw another uptrend. So if we get a new high, that would invalidate my concern, and we can still have some more room targeting the 100% extension in terms of percentage gains. IREN, so we had R2 that was 100% of R1 from this low to this high. And then this sell-off here had a double bottom. So this looks like a very classic corrective move. You've been knowing earlier waves, this being a wave A, B, C. And right now, I think we're seeing a similar pattern here. We might have a double top. This top didn't exceed this November high, and we're looking at a downtrend here that could complete at around 23. So that would be, in the classic early wave terms, an A, B, C corrective move down. Again, so I recently got a little bit underweight here because we had a shoulder, head, right shoulder pattern break down the neckline and pointing towards the bottom of the channel. The RT is in a very smooth uptrend. I think over here we're could be replicating the consolidation pattern here versus November 2025. And I expect it to resolve maybe sideways and touch the bottom of the channel and continue upwards. EQUIX. So EQUIX had a breakout from a 3-year consolidation where we had high highs, we had high lows, but lower highs. And if we look at the width of this consolidation zone as R1, R2 as a breakout has exceeded 100% of this. So I think we are potentially seeing a top here. And also because we saw the price basically break down from a double top, and now this support zone has become resistance. So I'm leaning cautious on EQUIX. Hot 8, it is in a beautiful uptrend, but over here we're previously seeing a pullback pivot at the top of the trend channel. Then we had a sell-off 1, sell-off 2. Sell-off 2 was 75% of sell-off 1. And then we had another pivot here, or a likely pivot. As we crossed the 50-day moving average, that was the confirmation of this pivot. And then we had a sell-off 3, which hasn't reached the 100% of this sell-off 1. So 100% would indicate a downside move towards 73, so near the bottom of the channel. But if we have a replication of sell-off 2, so 75% of sell-off 1, then it will be more benign. It would be more around the 100-day moving average mark at 86. Palantir, so sell-off 1 and sell-off 2. Sell-off 2 is about 80% of sell-off 1 so far. It got rejected by the 50-day moving average. So over here, I actually was leaning a bit underweight, and I'm expecting a mean reversal towards the bottom of this channel to complete sell-off 2. So sell-off 1 was also split into 2 phases. First sell-off, rebound, and sell-off. We might see the same here. ORCL is a big head and shoulders pattern, neck with a rising neckline. It has held so far, but if it falls below, I would expect 97 to be a minimum, because this is like 100% of S1 from this right shoulder here, but classical, and that's there's a point to the actual neckline being the start point, and 100% will reach something like 50. That'll be a more aggressive target in my view. Salesforce still in a broad downtrend. S1 and S2 were equal length. So if S3 repeats S1 and S2, it points towards 130. Now I think is service now I think is a bit more balanced. So sell-off 2 was quite aggressive versus sell-off 1. So we could have capitulated already. And the thing is, this rally here is not that convincing because it's got rejected by the 20-day moving average. So on the balance, I can see another rally potentially taking out the 200-day to confirm the bottom in place. But otherwise, if we get another rejection, we're looking at a sell-off 3 that targets 76. That's 100% of sell-off 1. Adobe. So Adobe in a really large downtrend. And so sell-off 2 was so this sell-off 2 is 100%, 25% of this sell-off 1, and within that it has 3 different sell-offs, each one longer than the other. So over here, I think really the key is not trying to catch the knife, but basically wait for trend reversal and an upward breakout. CrowdStrike, we're seeing rally 1 and rally 2. Basically, rally 2 has exceeded 100%. Basically, rally 2 has matched the 100% of rally 1. So natural point for resistance, I wouldn't chase here. Zscaler, so it broke out of this downward trend. So potentially this is a rally 1 and then rally 2 that replicates 100% of rally 1 that will test the 200-day moving average. So tactically, I would actually lean a bit overweight to play for this rally 2, and also around 118 is natural stop-up point in case it turns down and this is a failed breakout. But so far, a breakout retest and a challenge against 200-day moving average looks like a natural progression here. So before I go, I want to just round off NFLX. NFLX is showing a big head and shoulders pattern, but it's managed to hold on to this neckline. It looks bearish, but it hasn't broken down. So we can still invalidate this pattern and move higher. The reason I say that is because if you look at the left shoulder, that was actually a mini head and shoulders pattern, and it held its own neckline and then moved above to invalidate this bearish pattern and create a new high. So that is possible on the larger degree too. We just need the price really to start turning up now and start moving towards and past the 200-day moving average. So I do cover a lot more tickers now. I can't cover that everything in one go. I will have a think about how to split my time going forward. But I hope you found this helpful today, and good luck to everyone watching the World Cup. Thank you.